Hello and welcome to Your Business, Your Wealth. My name is Paul Adams. I am the CEO, founder of Sound Financial Group, and I welcome all of you, the Sound Financial family, to join me today for why self-insurance is a scam. Now, normally I would be joined by Corey Shepard. He was enjoying a nice week this week with family visiting from out of town. So you get me solo to rant on one of the things that I think is probably one of the most or biggest misconceptions about money. And we're going to get to that as we talk through why self-insurance is a scam. So why do I say self-insurance is a scam? Well, let's first start by talking about what is the definition of insurance. To insure something means you enter into a contract with some other entity. It could be a government agency or corporation called an insurance company. And what you're doing is transferring the risk or some of the risk from you to somebody else. Very, very simple. The idea of self-insurance came from the idea of large corporations who perhaps are paying millions upon millions of dollars every single year for something like health insurance. Now, they have enough money in additional liquid capital that over time, what they should be able to do is continue to pay all the claims, but then recapture a portion of the profit that would have otherwise been kept by the insurance company. Now, they can do that because they can do what's called owning the average. They have enough employees and a wide enough and diverse enough population of, say, 1,000 to 15,000 employees. They have enough mitigation of risk by being able to own the average claims rate because they are insuring everybody. The difference is when we try to self-insure on our own, we are a pool of one, meaning we don't get the opportunity to mitigate risk by spreading it over many, many, many people. That's the benefit of insurance. We're transacting for the average experience, which is we pay a price, and then if something happens to us, they will do their best to remunerate us financially for whatever the negative outcomes were from the event: disability, death, lawsuit, long-term care, all of these things. You could even do it with like your home or car, I suppose, if you wanted to. Many times people do that when they have an older car, is they will say, well, I'm going to drop the comprehensive insurance because I don't need that. I could replace the car that my 16-year-old is driving if there was a catastrophic accident that destroyed the car. So now let's talk about why self-insurance, that definition, is a scam when it comes to us as individuals. Again, we don't get to participate in the average. We just get our own experience. So instead of a pooled risk, which is what self-insurance is based on, we are a pool of one, and why that doesn't work. Now, for those of you watching on YouTube, you're going to be able to see this. I'm going to do my best to explain this for everybody listening on audio. What we have is a scenario of two different people. One person has $1 million home and has $1 million investment portfolio represented by the circle. The person on the right also has $1 million home, also has $1 million inside of some investment account, and has this little insurance policy up here. So let's talk about what happens if there's a catastrophic loss for the person that chose to, quote unquote, self-insure. Now, what we're going to do in our scenario is we're just going to imagine that what happened is there was a fire. So there's a big old fire and the house goes up in flames. No longer have a house. So they started with a net worth of $2 million, $1 million portfolio, $1 million home. The home burns down. And when the home burns down, the folks are able to use the $1 million of their funds to be able to rebuild the home. And that works pretty well. The home is rebuilt, except what has burned down, if you will, is our $1 million investment portfolio that we were using to self-insure the risk. Now let's look at the alternative. Now I know this is a simple scenario, and those of you listening, I'm sure this is easy to grasp. But if we had that same fire over here on the $1 million home, what we now have is an insurance policy that is going to be activated to be able to rebuild the home. That that homeowner's insurance policy that rebuilds the home, then rebuilds the home, and the person who had insurance, when they're done, still has a net worth of $2 million. And you say, well, Paul, what you basically just showed me is that self-insurance works. But let's go back to our original premise. The idea of self-insurance came out of corporate America and their ability to basically cut a health insurance company or even perhaps a property insurance company. Let's say somebody has a fleet of trucks and they say, we're just going to self-insure the loss of those trucks because they have 5,000 trucks and they can do that. And their hope is they will capture the profit that otherwise would have been maintained by the insurance company. In our case as an individual, we can only profit on the profit that the insurance company was going to make if there is no claim whatsoever. If there is a claim, we encounter the loss, meaning there was no insurance. See, the point of my story is not that people can't choose to not own insurance. You can absolutely choose to not own the insurance, whether that's car insurance, homeowners insurance. If you have your house paid off, you don't need to hold any homeowners insurance. It could be disability insurance, life insurance, long-term care insurance, the list goes on. All of these insurances are mitigating risk by laying the risk off, financially at least, on somebody else. In this case, the insurance company. When we retain the risk, that's all we're doing, is taking the risk. You're not doing any kind of self-insurance. You're actually just choosing to take the risk. And this is why I bring this up in today's episode, is my concern is that people aren't being straight with themselves about the risk they're taking. They feel as though, well, I don't need to pay $500 a month for my disability insurance or whatever their disability insurance is, $200 a month, etc. I stop paying that and therefore I'm self-insuring. So even if they put that money in a bank account, it doesn't work. Because if that disability insurance policy would have paid your family $10,000 a month, but in 2 years you get disabled, all you have is $4,800 in an investment account plus a little bit of growth to mitigate what was a significant loss of income, and you need $10,000 a month to replace that income. So you just took the risk. So if there's anywhere you and your spouse have been thinking about that you're quote unquote self-insuring, I'd like you to just take some time and reassess that. Take a look at really what is the risk that you're taking. And here's just a quick fine point on risk. When you're taking risk, is it risk that gives you a big enough benefit that it'll solve all your financial problems? And if the risk manifests, is it enough to completely dismantle your entire financial picture? And here's what we find most of the time when we do the math. I'll save you guys the math today. Is that if you take a look at the amount of money you would save by not owning whatever the insurance is that you're quote unquote going to self-insure, as we say, take the risk on, you'll find that it doesn't end up being enough money for you to actually make any difference in retirement. That if what you needed was $8 million, and even with all the cost of premiums and all the lost opportunity cost, let's say it made a $50,000 difference by the time you're age 65. Well, is the difference between $8 million and $7,950,000 of capital at work going to be what prevents you from retiring or not? Heck no. So even if it worked really well to set aside all of the money from what we would have paid in insurance premiums, and that money performed really well and inflation wasn't too bad, and we get to retirement and we never spent the money for something else and we consistently set the money aside. You kind of get, I'm giving you a very perfect scenario of human behavior in this idea of self-insurance, and yet that self-insurance only made a $50,000 difference in our old age, which equates to almost zero difference in our retirement income and therefore does not prevent us from retiring. But what could prevent us from retiring? Whatever that risk was that we were protecting against. I'm going to say that again. Whatever the risk is that we were protecting against, that could definitely dismantle your ability to build financial independence. To go back to the question about disability insurance, if you're listening to the podcast or if you're watching on YouTube, on the disability insurance subject, I would encourage you guys to go check out, and we'll put it in the show notes, the worst case scenario, where I interviewed a client of ours who actually was kidnapped as a part of his job. It wasn't his job to get kidnapped. He was kidnapped because of the job he had running jewelry stores. He killed both of his captors and ended up permanently disabled as a result. Now, that could have dismantled all of his future financial aims, but instead he had dedicated a little bit of money to disability insurance for the prior 5 years, And when he did, that was the one thing that stood up and made sure he didn't lose everything. So just be clear with your spouse, with anyone you're doing planning with, or with your insurance person, or with your financial advisor. If you don't have one, reach out to us. We'd be happy to chat with you. But the key is, if you haven't really gotten clear at what the impact would be to you and your family if that risk manifests, then you didn't even do the math yet to know how big the risk is for this self-insurance. And that makes the point I made at the very beginning. The problem with this term self-insurance and why it's such a scam is because it puts us in the position of not really taking the risks that we're taking as seriously as the risks that we're taking. That was a terrible sentence, and so I apologize to any of my past grammar teachers, but the idea being is we're not appreciating the gravity of the risk we're taking when we simply say we're self-insuring. And incidentally, nearly everyone I see who's self-insuring is actually just kind of living the same life they've lived. It's not like they take the hundreds of dollars a month that we're going to go to the quote-unquote insurance and set it aside. So with that, I hope that this was a contribution to you. We love you guys in the Sound Financial family, and I love it when we get to see comments, when you guys talk to any of us at Corey, Paul, Jeff, any of us at Sound Financial Group. We love when we get the feedback that you enjoyed the episodes. Please make sure to put in a comment. Don't forget to subscribe. And if you give us a review on iTunes, take a screenshot of it, send that to us at info@sfgwa.com. And we will send you a copy of our most recent book. With that, we hope that this contribution has... With that, we hope this episode has been a contribution to you being able to design and build a good life, and we will see you here next week.